Good morning, everyone. It's 11 on the dot. My name is fiscal, and today I'll be taking you through some of the highlights from our Alibaba Investment Idea Report. So on the summary side of things, Alibaba operates in a highly competitive environment with slower demand when it comes to Chinese consumers specifically. Then they've got a lot of high execution risk when it comes to their growth strategy moving forward, while the valuations look attractive. Now, what we try to do is really contextualize that a little bit better to see what the valuations are really pricing in and why there's a little bit of high execution risk when it comes to the growth strategy going forward. Now, we have an intrinsic value of about $164 per share with an upside of 73% and a buy recommendation. Our recommendation is based on a couple of things. The first one is just exposure to the structurally growing Chinese online consumption. Second point is just strategy focused on re-accelerating growth by improving user experience and adjusting to the macroeconomic overhang by offering value for money positioning to increasingly price-sensitive consumers. Then you've got some structural reforms and fiscal support from the People's Republic of China, providing a tailwind to ignite domestic demand. Now, it's important for us to say this. Now, they also want to improve product quality and delivery times in ex-China regions of operations. Now, it's very important for us to, similar to the structural reforms, to really highlight that Alibaba does have some exposure in ex-China. It's about 12% if we really use Alibaba International as a litmus test, or at least a proxy for that. Now, even if they do really well in improving product quality and delivery times within those regions, the bulk of the growth, in fact, the bulk of the earnings really reside in the performance and execution of the strategy within China itself. Then you've also got the artificial intelligence and cloud strategy, which basically just focuses on the vertical integration across design and infrastructure to enhance optimization while positioning the group to offer cost-effective AI services. And all that's basically telling us is that they want to be involved from the design, the production, and the implementation of their own silicon throughout their infrastructure in order to be a lot more cost-effective. If you're involved in every single step, you can optimize a little bit better, and you can get a little bit of a better bang for your buck for the AI services. Then the other thing we've just got is balance sheet and cash generation remaining areas of concern. Now, Alibaba itself doesn't have a lot of debt within its balance sheet, but its cash generation has taken a bit of a nosedive over the last 3 years or so. Alibaba faces a lot of elevated execution risk within a highly competitive markets, particularly when it comes to China itself, along with the weaker demand domestically. Then the near-term execution of the strategy has seen a slower top-line growth. Now, again, it is important for us to mention that we've got a very small sample size when it comes to the current execution of the strategy, which is just 1 year. But what we should be seeing is high top-line growth and a little bit of a margin squeeze. But what we're seeing is very marginal top-line growth and a large margin squeeze, which means that the execution risk on the medium to long term remains quite high, because based on the data we have at the moment, we're not seeing the successful execution of the strategy. Now, while we assign a higher weighting to the bear case because of our concerns around the balance sheet and the strategy execution relative to the bull case, we nevertheless reach a weighted intrinsic value with a high upside and recommend a buy based on valuations.